Okay, good morning, everybody. It is the 26th of February, 2015. I believe it's a Thursday. I need to check that. I never know, actually, for sure. Yeah, it is a Thursday. And this is your daily Forex trading strategy session. My name is Wayne McDonell. I'm the Chief FX Market Strategist, Traders Way. You can call me Traders Wayne. Today we got some technical analysis that we should go over. Now that a lot of the central banks have said what they're going to say, maybe we can get some trends. The other thing we could do is very quickly look at markets as far as gold and oil and stuff. Look at overnight news and then maybe find some trade plans. I think we had some questions about binaries. There's a lot that we can do today, so let's get started, huh? Remember, trading and investing with leverage is risky and appropriate for everyone. Your past performance, good or bad, does not predict future results. Stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. If you're attending this session live at tradersway.com, welcome. If you're watching on YouTube, watching a recording of it, then hey, give it a like and maybe join us. We do these Monday through Thursday. Just come to tradersway.com. It's free. Just open up a demo account. We're trying to build loyalty with you. Maybe one day you'll open a live account. Hey, let's get going. Yeah, well, we got a request for pound dollar. This is pound dollar. Hey, Marcia. Yeah, Marcia wants pound dollar. Okay. All right, and any major change here? Well, price action was, yeah. What do you guys see here? Yeah, the lower low. You know, you might even call it a head and shoulders, right? I haven't touched this chart since yesterday or even the day before. I can't even remember. I think this gray zone we drew like 2 weeks ago. Okay, lower low. Is it noise? Well, here's the thing. The reason this is a gray zone is we identified this as a potential reversal zone for pound dollar to continue its downtrend. So below this, we knew that we didn't necessarily want to sell yet. The gray zone was, hey, if we got a reversal pattern in this gray zone, it could be an important beginning to the continuation of a downtrend or the end, you know, of the short-term uptrend that we've had. That's all. So this gray zone, we're looking for bearish reversal patterns. And I think it's important that for the first time in a very long time, we have a low here and then a low here and now a low here. Does that look on the, this is a 15-minute chart, by the way. Does that look like a bullish, you know, bullish price action? Certainly doesn't look bullish, right? So it's potentially a short. Now, you probably would agree. Let me, instead of using a pen, let me use a line. Here it is, a line. You probably would have noticed that that is a lower low. Did you? Was this something that you were looking for? Now that's the key part, right? That's what trading's all about. You're sitting there waiting for something like that to happen. Okay? Oh, Joseph did. Right on, Joseph. Okay, important. Now, the other important thing is, if there was an uptrend, and you could see we came down to the 21, rose like you would have thought, right? What would the next thing, what is the next thing to occur if you're a bull and you expect the bullish trend to continue up? What would you expect to happen at this point? A higher low. Okay? And if you're a bear, you're just sitting around waiting for a lower low, right? Or a clue. Well, you know what? This is where it's supposed to go up. Okay? Right? Based on price action. So a bull would have assumed down and up to the next level, right? So you get a higher high, higher low, higher high, higher low, higher high. Now, it's unfortunate that it went below the 21, but it's not, you know, it's not the end for a bull. They would think, oh, it's just going to come down to the 55, and then that means we're going to be vulnerable to a double top and blah, 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 blah. But we went through that red zone, and that's the first heads up. Getting below that, before you've even made a lower low, you're not really supposed to make 100% retracement, are you? If it made 100% retracement, then it's consolidation, correct? You say, okay, well, that's probably the end of the bullish game. The bears haven't kicked in, but, you know, something important's happening. But down here, absolutely not supposed to happen. In fact, that's where the bears are supposed to get into the game. What do you do after that? Well, one thing that I've taught over the years, as soon as you see something like that, okay, now we're looking at the lower low scenario. Is the world's greatest lowest low? No, but it's more than 100% retracement. So what it means is this part is spent, okay? So once you get past that level, you want a fib, okay? And generally when you use fib, whether you're fibbing up or down, I prefer the sweet spot between the 382 and 618 Fibonacci retracement. Okay. And here we are at the 200. And it makes sense. Okay, that move. Another way of doing it, let's say you don't use Fibonacci. Okay. Because you don't have. I mean, they're just tools. You know, there's probably 9 different ways you could trade this, but it's all essentially the same thing. What I tend to look at is just the same as what we were looking for before. Okay, what's the bullish trade for, or what's the trade for the bulls, right? They would have expected this. So what's the scenario for bears? After the lower low, it's essentially the same thing. Watch. Down, back, gone. That's very, very common. Okay? Very, very common. Now, when I use the fib, it predicted, you know, we hit about 50%, not quite 618. So 50% predicts somewhere between the 382 and the 1382 and the 1618. And that's what we got. Right? Again, let me show you. Okay. See, if it hit the 618 here, oops, let me get back to drawing tool instead of the line. Tool, pen. Okay. Okay. Here, if it hit here, I would expect the 1382. This is in my book. I'm not making this up. If it kicked off the 382, I expect the 1618. Well, it hit the 50%. So I don't know, somewhere in between the 1382 and 1618. If you're using moving averages, this is a step down. Okay, from the 382. Sorry, the 21 EMA was in control, right? Boy, I'm stuttering today. First the 21 EMA was in control. Then the 50%. Can I try this? What is it, 9 times? 21 was in control. Then price stepped down to the 55 EMA. The 55 was in control, or should have been in control. And then that broke. So the next assumption is that we're going to retrace back to the 200 EMA. Okay. A step down, a reset. See, I consider the 200 EMA the equilibrium point in the marketplace. Yeah, big word, right? What it means to me is it's where the bulls and the bears probably agree, at least on this time frame. Okay? So if the bears are going to continue the downtrend here, your trade plan is to have it come up, and the things that are in play is this previous zone, this EMA, and that EMA. So why don't we just say that's a short zone right there. And your trade plan as a bear is to do this. Now, as a bull, do you buy the 200 EMA? What do you think, guys? If you're a bull, I mean, if you're a bull here, you buy the 21. Okay? Okay, that's what you should be doing there. What about the 200? No! The 200 EMA is a target, not an entry. It's the equilibrium point where the bulls and bears agree. How would you possibly know which way it's going to go? See, you're not big enough to move the market, so you need to trade with the bulls or with the bears, but nobody knows at this point if that's the equilibrium point, if that's the fair market value. How do you know if it's going to go up or down? You see what I mean? Now, if you're a bear, then you got to wait market to be wrong, wait for the market to be mispriced, and then sell. But not, okay, but now we're at this point where it's not overbought, nor is it oversold. Do you see my point? Okay, here the bulls were very confident, so you should trade with the bulls. Here the bears were quite confident because they just made a lower low. They're confident, you should trade with the bears. But here, I don't think anyone on this time frame has confidence. It could go one way or the other. Okay? So for example, I see a 2155 cross. To me, technically, the market has turned bearish, technically, and only on this time frame. Market defined by the 2155. So I could see how it could come up there on this time frame and down. Okay? Target probably here. Okay? Do you think it'll be respected if we made that move indicated by the blue arrows? If we got into that red zone, do you think we would have at least a bounce, but maybe and potentially a reversal? Yeah, just like we talked about yesterday or the day before, I think it was here, right? And I said, I would be shocked if we didn't respect that level. Now, did I say it would reverse? No. How would I know? But I'd be shocked if the market just ignored that support level, right? So I think we would come down here, okay? Now, the gray zone is an area where we expected price action to possibly give us a reversal pattern like we saw here. It's the pattern we thought about, hours or even days ago, that it might happen, and if it did happen, it would probably happen in this gray zone. Now it did. So there's some hope here. I know it's not a strategy. So you got two things. Hey, it might stay range bound. We do this and stay in the gray zone for a while. But I think there's more potential in the near future for this. Okay? We'd come down to this level, right? Do you think, oops, come on now, drawing tool gets slow. Okay. I think we would get down to about here. And then what? Okay. But I wouldn't sell at the 200 EMA. It's a target, not an entry. If I were to sell, what's the golden rule if you're a bear and you want to sell? What's the golden rule that you should learn on day one of trading? If you want to sell, if for whatever reason you decided to sell, you want to sell high, right? Sell at resistance, sell high. Well, you're not going to have resistance low. So now you're bearish? Well, you're too late. So are you patient? Are you disciplined? Well, let me ask you this. Do you think it's important as a trader to develop patience and discipline? Yeah, 12 or 15 years ago, I can't remember, when I first started trading Forex on my own, before I quit my day job and all that kind of stuff, I went through some periods of struggle and strife. And now this was so long ago that Forex trading accounts didn't even have charts. What? You think Forex is hard now? And and you should have seen the volatility back then, guys. The market could jump 200 pips in 10 minutes. Now it doesn't move 200 pips in a day. Okay? But anyways, I was trying to figure out how to be a trader, but I didn't know any traders. Most Forex traders were just bankers. I mean, this was even really for retail. This was in the very, very, very first days of retail Forex trading. Okay? And I was trying to figure out what the heck I was doing. And I thought, well, I need to hang out with traders. I need to find some traders. I'd like to be groomed by a trader. Because I thought, if I got hired by a big bank, they would bring me into the trading room, give me a trading desk. There's probably a senior trader that walks around, oversees everybody, and by and large you try to mimic the senior trader, right? And hopefully that person sits down with you and reviews your trades and says, yo, you know what, in these scenarios I've found that this reaction is best, and you just learn, right? It was a very inefficient way but I think that's how the market was. But hey, I didn't have a bank. I wasn't going to an Ivy League school yet. Now, but so I decided I would just write down all the characteristics I thought that this mentor of mine would have. And I thought about it. Well, what would you need to be a successful trader? What kind of personality and traits would you have? And patience and discipline came up. And so why the patience and discipline? Okay, you've missed this trade. I think if you were looking for it, now listen to me on this. I think if you were looking for that trade, you would have found it. Humans are really good for that, at that. We see patterns. In fact, I was reading how important this was to psychology and the mind. motorcyclists get hit when a car turns left. And do you know it's not because the car driver didn't look before turning left? Do you know what actually happened? What's the car driver looking for when they left? When they look they look left before they turn, right? What are they looking for? Cars. So we're so good at it, guys, that you can look left, see with your eyes, right, the motorcycle, but your brain completely ignores it. So they turn left. No car. Boom. Hit the guy on the bike. Didn't even see him. Looked at him. You know this, right? You know, have you ever seen a yellow Volkswagen? Well, you're going to see yellow Volkswagens for the next 3 weeks. Yellow ones. Who buys a yellow Volkswagen, for crying out? But you're going to see them if you look for them. Really, Joseph? I thought you had the blue Geo. You dumped the Geo? Your 69th wife? Wife number 69? Anyways, so I'm suggesting that you can look for this. Now, if you're patient and disciplined, and if you honestly believe that that's an important character trait that you should have as a current trader, what I did was I just faked it. And I said to myself, I made it like a game. I want to short this. I want to short this. I feel like I'm missing it. I'm missing it. I'm missing it. I'm missing it. I'm going to miss it. I'm going to miss it. I got to short. I got to short. I got to short. And then you make it a game where you're just like, how long can you wait? How disciplined can you be? Now, most of the time, it does come back. And that's called a trade plan, guys. You can't sell at the 200 EMA. You can't sell low. You can't sell at support. But now you can wait. And it's not much more than waiting for this. Okay? This is a reversal pattern. This is the second chance. There's almost always a second chance. Not always, but I like to describe it this way. And before I describe it, I want to go to something that you might have felt over the years. Have you ever felt that there's somebody in the market that just sits around waiting to trade against you? Soon as you go long, the market falls. Soon as you go short, the market rises. And you could sit there for 8 hours, 9 hours watching price action, and everything behaves properly. And the minute you trade, it doesn't behave properly anymore. And you're just like, I don't get it. Why are they after my 3 pips? Right? And what it is you're just trading late. Right? Now, you're with Traders Way, they're ECN, so obviously they're not trading against you. They don't even touch your trades. They pass it to the intermarket, right? So now you're in the interbanking system, and I don't think Deutsche Bank's waiting for your one mini lot trade. So you're late because you're trading down here. You're late. So what you can do, though, is say, look, Forex doesn't hate you. And this is what it came from. Like, I know I've had feelings, when I first started, I honestly felt like the market hated me. And I couldn't figure out why I was so special. Why are they waiting for me to trade, right? How do they know it's me? This market hates me. And then I created, like I said, this imaginary perfect trader, my mentor, my invisible mentor, sort of like my invisible friends, this mentor of mine was teaching me patience and discipline. So I ended up just waiting for these pullbacks. And I proved to myself over the years that the market doesn't hate me. The market hates stupid trades. You put in a bad trade, you will get punished immediately. It's an efficient market. You're a liquidity event for someone's profitable trade. That's how it works, guys. Somebody on the other side of your trade made money. Why? Because you bought where the guy was trying to get out for profit. Now you take it, right? That's how it works. It's a zero-sum game. So then I found that if I waited for the second chance, that the market loves me. Because the market loves a well-placed trade at support or resistance in the direction of the prevailing trend, something that took a little bit of patience and discipline. Not courage. If you feel like your trading is courageous, it's because you're betting. So Forex loves you. The market loves you. It's like, oh, Wayne, I just showed you a lower low. I'll wait for you. Right? And then you wait and you sell high at resistance. Or if it's the other, if it's the opposite scenario, you buy low. Okay? And now you're like, but Wayne, look, it's still going through. The thing is, here, you don't know. Okay? Maybe your odds are what, 50-50? It might go up, it might go down. If you like those odds, you're a degenerate gambler. Oh, I bet you it'll go up. Well, how do you know that? Someone else will say, well, I bet you it'll go down. And they'll give all these logical reasons. But you're either late as a bear or you're early as a bull. I think if you sat there and did that, if you bought or sold at the 200 EMA, I think if you did that over the course of a year, you'd find out that there's no, sort of repeatable, profitable trade there. Probably half the time you'd win, probably half the time you lose. Your broker's happy. But I think what's going to happen is you get into lots and lots of mediocre trades, which then lowers your discipline, which means you probably get into some other losing trades. If you're willing to take that and you're lucky enough to get out 50-50, then you're going to get into other undisciplined trades, either too late or too early. And over the long haul, you'll have nothing consistent, nothing repeatable. And do you think you'll be a confident trader at the end of that? No. So you'll have you'll have no consistency, you'll have no discipline, you'll have no confidence. Like, hey, good luck. Or take my advice and just sell high. So when you're at the 200 EMA, are you selling high if you're going to trade? No. Well, then don't do it. Are you buying low? Well, you better be confident in what you're doing, and I don't see it on this time frame. So you might have to go to a different time frame and say, Wayne, I'm going to buy the 50 on the hour. All right, fine. I don't think I'd be that interested. I think the buy zone is down here, but we've already talked about that. Okay. Do you want to sell, right? So let's do it this way. Do you want to sell when it gets down to this red zone? No. Yeah, maybe a buy. Okay. So find the extreme entries, right? Where's the support? Where's the resistance, guys? And if you're doing something, in this zone that we've just identified, Does this really look like a good place to sell or a good place to buy when you look at it on this hourly chart? Do you think that will consistently go up or consistently go down? No. So that's all I'm trying to point out, right? So one more thing on this, and then we'll go through some charts. I didn't mean to go on such a long tangent, but I thought it was important. This gray zone, okay, that's why it's a gray zone. Do you see it? We talked about it days and days ago, maybe over a week ago. I also think that's an important part of the discussion. This is why I said, if you were looking for a reversal pattern, I think you would have noticed that lower low. And you had the potential to take that nice trade. The nice trade, let's go back to the hourly chart here. Or 15-minute, right? There we go. This is the nice trade. You should be in basically here. Oops. Come on, drawing, don't fail me. Okay? That's the nice trade. Okay? You might have traded it here as well and it didn't work out. Well, cry me a river. Okay, because you would have gone from here to here. It didn't make a lower low, but it made a significant drop. Maybe that's because it didn't make a lower low, we're not ready. But if you're in that gray zone and you're looking for reversal patterns, I mean, this isn't, you know, this is what, right after the London Open? I mean, it's a pretty reasonable time of day and everything, right? So that's the idea. If you were looking for a reversal pattern, you probably would have seen it, and it probably would have set up for you, right? And this logical zone, and like I said, it's not a complicated thing. You could have used a fib, you could have used price action, right? I mean, look at this, right? Pretty obvious stuff. You know, selling it at what, 55.55. Now we're at 54.88. You know, we're on our way. 75 pips later, right? Cool, right on. Price action. You guys want to do just a quick review of European news? I got out of order with that discussion. Sorry about that, but I hope it was helpful. People's Bank of China, right, approves an additional 0.5% for RRR cut. How many people know what RRR is? I'll probably need to dedicate an entire 2-hour webinar just discuss central banking policy. The reserve requirement ratio. Yes. This directly impacts the money supply. Okay. So, if you cut the amount of money banks are reserved or required to keep in reserves, because it's a fractional reserve banking system, okay, then they are allowed to take more of the money that they have and lend it out. If they're lending more money because they're not required to have it in their vault or at the central bank, then the money goes into the market and the supply increases. What happens when supply increases? What happens to value? Falls, creating inflation. Now, do you think that's a big deal? China adjusts the reserve requirement ratio all the time. When was the last time the United States of America changed the reserve requirement ratio? Are you Googling it? Nobody? 1992. Kareem wasn't even born yet. Yeah, 1992. Now, do you think a 0.5% change in the reserve requirement ratio has a big cut or a big impact or a small impact on the money supply? I mean, it's only 0.5%. Who cares? You know what? It's such a big deal that the Fed almost never, ever, 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 ever changes the reserve requirement ratio because it has such a dramatic effect on money supply. It's redonkulous. Okay, DeBeesta says it's in trillions. Why is 0.5% such a big deal cut in the reserve requirement ratio? What do you care if the Fed, for example, cuts the reserve requirement ratio from 10% to 9.5%? What's the big deal? If you cut interest rates, if you cut the Fed's fund rate by 0.5%, it's not that big of a deal. I mean, it's a big deal that they had to, but that big deal already happened. Their response, if they cut an interest rate by 50 basis points, I mean, it's helpful, but it's not going to rock your world. But a 0.5% change in reserve requirement ratio, why is it such a big deal? Yeah, more money, so what? How much more money? There's something in fractional reserve banking called the Money Multiplier. So, in the United States of America, reserve requirement ratio is 10%. So, if I go to a bank in the United States and I deposit $100,000, that means they have to keep $10,000 in cash. Now, they don't keep it in the vault, they send it to the Fed. So now they have, it's sitting at the Fed, but that's required, right? This is how it all works. And what do they do with the rest of the money? What do they do with the other 90,000? What do banks do, guys? Lend it out. Yeah, they're going to pay me 0.5% interest, and then they're going to loan it out to a business and charge them 5%. Or buy some bonds or something, but the best return on asset or best return on equity is going to be, that's what, generally speaking, that's what banks do, right? So now Adam goes into the bank and says, I'd like to borrow 90,000 bucks. The bank says, sure. What do you do with your money, Adam? And I don't mean what do you do with the investment. What physically happens? The money's transferred to your bank. So Adam now has 90,000 in his bank account. Adam goes down the street and buys a used Porsche for 90,000 bucks, cuts the check. Check goes to Porsche. What does Porsche do with the money? Put it in their bank account. But see, what's happening is then the bank, right now Porsche has 90,000 in their bank, which, right, 9,000 has to go to the Fed, and 81,000 gets loaned out. And then that goes to someone's bank, and 10% of that is held at the Fed, and now that's lent out. Do you understand? So now you might have 25 banks, all with deposits and making additional loans because they keep putting 10% at the Fed, loan out 90%. 10% to the Fed, loan 90%. So the $100,000 that I deposit, how much money gets added to the money supply? Okay? Simple math. 1 over R plus E. You get the money multiplier. Okay, 1 over the reserve requirement plus the excess reserves, whatever. So anyways, my 100,000 gets turned into $1 million. What? Holy moly! What? So, a small percent in the change in the reserve requirement ratio. How do we end up talking about this? Anyways, the small cut in China of the reserve requirement ratio changes the money multiplier, and now the money multiplier goes up dramatically. So let's say in my case, you know, $100,000 deposit could now be like worth 1.2 million or 1.3 million because it gets deposited, loaned out, deposited, loaned out, deposited, loaned out, deposited, loaned out. All right. Cash on hand doesn't change, but the banking, because of the fractional system of deposits and loaning out, increases the money supply. And this is what gets, you know, now industry is working and jobs and all this stuff, and more money gets deposited, more money gets lent out, more, you know, more products are bought, more services are bought, more employees get paid, more deposits, more lending out, more lending out. And this is how the filthy rich get filthy, stinking richer. And poor countries without a decent banking system or a decent bond market, what happens to them? They stay poor. There are rich countries with a banking system and a bond market and all these things that are required to have a modern economy. They've become more and more rich because their money is being multiplied over and over and over again. So for example, what if you couldn't borrow a loan to buy a house? Well, why do you buy a big house? You buy a big house because you get married and you start to have children. But you haven't been working that long and you don't make much money. So how can you buy $1 million house if you don't have $1 million in cash? Well, you'd have to work your whole life to get the $1 million in cash, but by the time you had the $1 million, your kids have grown up and you don't need a big house anymore. So what happens? You just leave the money under your mattress. And nobody, right? So you don't buy the house, you don't fix up the kitchen, you don't go to Home Depot and buy stuff, and people at Home Depot don't get jobs and they don't get paid, and you don't buy things online and have them delivered. So, you know, UPS guy loses his job. You don't put a new roof on, you don't hire a plumber, you don't hire a landscaper, you don't hire an electrician. Nobody makes money. It all sits there under the mattress. Nothing gets multiplied. Nobody makes loans. There's no productivity in the industry. The market's dead. Everyone's poor. Life sucks. Or you have a bank. and you do the opposite. So anyways, a cut in the reserve requirement ratio in China is a big deal. And yes, DeBeast is right. This is going to add up to big, big, big money. So they're doing a lot. So anyways, again, another tangent. Now you guys just learned about central banking and the fractional banking system and the money multiplier. Well, Anthony, you tell me now. Let's go through the logic. China is pumping billions and trillions of dollars into the system that should spur growth and encourage investment, putting money throughout the supply chain. So if that stabilizes the Chinese economy by creating inflation, and let's say productivity and stuff, what is another result of that? Well, okay, Chinese economy is stimulated. Maybe they're going to need outside natural resources like gold, like oil and stuff, because their economy is growing, not shrinking. So now you could look at things like maybe the Aussie dollar, maybe the Canadian dollar, so on and so forth. Right. You can't trade the reserve requirement ratio. There isn't an instrument for that. But the money's going to go somewhere, Anthony. And if it crosses the Chinese border, it does, it can, in certain ways, right? If the money crosses a border, it's going to create demand for the currencies that they're being converted to. Okay? So, if the Fed does quantitative easing, it lowers the value of the dollar because it's increasing supply. And if any of that money leaves the United States, then that's going to create demand for another currency. Let's say if it left the United States to buy Canadian oil, then that money now is buying Canadian dollars, driving up the value of the Canadian dollar and continuing to lower the value. But more money can be invested in other places, and that can create demand for other goods and services, so on and so forth. So that U.S. money could go to Canada. Did you notice that when we did quantitative easing, the dollar fell in value because the supply went up, because the Fed was pumping money into the system? But what went up? If the value of the dollar went down, what went up? Asset prices. This is why I said, like, quantitative easing in Europe? You haven't been buying the stock market in Europe? Why not? That's what it's designed to do. So the Fed, when they did it here, lowered the value of the dollar, but the value of assets went up, like the stock market went up and up and up. But it also had a positive impact on the Canadian economy. Why? Because some of that money they were printing eventually found its way to Canada to buy oil and to buy stuff. I don't know. But more money to do what? To buy stuff with. So you got to just figure out now, where's that money going to go? So China pumps billions and trillions of dollars into Chinese economy. If some of that goes to Australia to buy gold or coal or iron ore, diamonds, wheat, beef, wine, art, right? Vacations, anything that's going to positively impact property. Yeah, of course, right? Especially with low interest rates, right? Good time to be a Chinese investor wanting to build and buy in Australia, right? And eventually that should have a positive impact on Australia and the Australian dollar. So you follow the money. It's money flow, macroeconomics, but it starts at a micro level, doesn't it? Okay, German unemployment, 6.5%. They're losing jobs every month, right? Is that right? No. Yeah, no, it's not their employment. Their unemployment has fallen, which means their employment has risen. All right, so it's a double negative. But anyways, pretty better than expected number out of Germany. But so what we want to watch over the course of time is as Draghi and the European Central Bank start buying their own bonds, printing money and buying their own bonds, will it have a positive impact on things like, well, what's their mandate? Price stability, right? Inflation. But eventually, if to increase inflation, people have to have money, and if they're going to have money, they're going to have a job, right? Richard says, how does QE get into the economy? Very similar to like the money supply we just went through. If you adjust the reserve requirement ratio, that's one way. But the Fed, it buys bonds, right? So where do they go? They go to a bond dealer. There's 12 major bond dealers in the United States, like JP Morgan and stuff, right? So they call up JP Morgan and they're like, hey, we need, we're going to buy $85 billion worth of bonds this month. So, you know, we need $10 billion from you. Okay? So they're like, okay, here you go, Fed. Here's $10 billion worth of U.S. Treasuries. What does the Fed give JP Morgan? $10 billion. What does JP Morgan do with the money? Because now they just sold an asset. They actually sold an asset that they already owned. See, the Fed doesn't go to the Treasury because it would have no impact on money supply to just give it to the government. So they go to JP Morgan and other dealers, right? So what does JP Morgan do with a $10 billion check after selling those assets to the Fed? They put it in their bank account, of which $1 billion is required by law to sit at the Fed, and the other $9 billion gets lent out or kept as excess reserves or invested into another, bond, but it gets sent out through the fractional reserve system. So money supply goes up, right? And that $9 billion gets lent out. So $90 billion get created in the money supply eventually, and it's just awesomeness, right? And so that bank lends it out, and then that money somehow goes somewhere, and then it goes into a different bank account. That gets the reserve requirement kept at the Fed. That gets out to another bank. Another bank gets those deposits. 10% of those deposits get put at the reserve, and that gets sent out, and the $9 billion gets turned into $10 billion to $12 billion to $20 billion to $50 billion to $80 billion, and it just goes from bank to 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 bank. And pretty soon, some Joe Schmo wants to buy a yellow Volkswagen, and his credit union says, yeah, sure, no problem. We'll give you the loan. And then what? Then you go to the the Volkswagen dealership. The Volkswagen dealership gets the money, puts it in their bank account. And then they have to call up Volkswagen. We need more Volkswagens. Volkswagen borrows money, starts buying raw material, keeps the factory going, hires some workers. The workers get paid. What do they do with their paycheck? They put it in their bank account. 10% gets put to the Fed, 90% gets lent out. And just all of a sudden, over the course of time, and it takes about a year, over the course of time, every dollar gets turned into $10. Over and 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 over. The money multiplier effect. Yes. 1 over R plus E. E is excess reserves. Traditionally, banks didn't ever keep reserves because you don't get paid on it. But now they do because they're so worried of their toxic assets. Now there's tons of reserves. But still, those reserves the excess reserves should come down over time. Whew. How did you guys get me into this discussion? I hope it was helpful because I'm sure you get this type of information from other sources. Next time, can you at least let me prepare? Like maybe I could produce a slide or something. So yeah, China lowered the reserve requirement ratio by 0.5%, 50 basis points. Woo! You guys inspire me. So Conrad had never heard of that before, but I mean, I don't know, does it help explain what's been going on? globally. Like, so we've ended quantitative easing in the United States. Our discount rate, the discount interest rate is artificially low, should be raised soon, probably before the Fed funds rate is raised. And then when that's done, then, so the discount rate is going to be first, and you might not even know what the discount rate was, right? And then the second thing is the Fed funds rate is going to be adjusted. And you might not even know what that is, but this is what they talk about at the FOMC meetings, right? And then what? That's going to affect the bond market, so suddenly the 10-year T-note is going to be affected, which then means things like prime rates are going to be affected, your mortgages are going to be affected, your credit cards are going to be affected. And yet, what? 90% of people don't know anything about this stuff. And the person in charge, you don't even vote for. What? So anyways, anytime you want to talk about that, you know, I can add 2 cents to inflation and deflation and all that kind of stuff we can talk about. All right, so I guess we got to go. I mean, it's been, you got me going on, we talked for a half an hour on reversal patterns at resistance. And then you got me talking about money supply, M1, for a half an hour. What's the difference between M1 and M2? You guys ever read about that in the newspaper? The M2 money supply? And you're like, well, what is that? Yeah, we'll have to talk about that someday. Yeah, but do you read it? Everyone's Googling. Nah, don't Google it, right? But does anyone read about that, or is it not even on the radar for you? Yeah. M1 is liquid, Marcia is correct, partially correct. Okay, money in the hands of the public, which is cash, and checking deposits. That's M1. M2 would be savings deposits, time deposits like CDs, things that could be quickly converted to cash. Okay, M3 is more like stocks and bonds. And see, even gold isn't necessarily liquid. If you had a gold bar, yes, you could trade it, but still you need it tested and verified, and then, you know, a bunch of other things. And you can't buy a loaf of bread with a 1 pound bar of gold. So it's going to have to be converted, and, you know, it's not as liquid as you would think. But a checking deposit is on demand. Cash in your wallet, on demand. Stocks, what happens if you own a share of Google and you want to convert that asset into another asset, like a computer laptop? You want to sell your 1 share of Google to buy a new laptop. How long does that transaction take? Well, you call up your broker, sell my Google share. He says, okay, that'll be executed at the end of trading today. You'll be liquidated in the morning. T+3, you'll have your cash. So it's going to take like 4 days for you to get the money in your account. Then you got to go and then buy your laptop, right? So it's liquid, but not that liquid. You see what I mean? So hey guys, got to roll. I enjoy my time with you. I hope you gain lots of value. Trader's Way wants to build your loyalty. If you like these events and you want to keep them going, it's really simple, my friend. Put some money into a live account. We're happy to have you on demo, all that kind of stuff. But the Trader's Way is trying to earn your loyalty and be your trading partner for throughout your successful trading career, and that's why they're investing into this resource up front. Doesn't have to be a lot, but it should be something just to say, hey, you care. Okay? And it's the end of the month. Maybe they don't renew. Maybe this doesn't happen on Monday. So if you're thinking about it, today would be the right day. Okay? You get it? Wink, wink, nudge, nudge. Take care of yourself, you hear? Cheers.